What if I told you the 2008 financial crisis didn't begin in 2008? What if the collapse that wiped out $2 trillion in global wealth, cost millions of jobs, and nearly broke the world economy, actually started with a simple idea that sounded like progress, a lie that looked like innovation, a product that looked like opportunity, a system that looked too big to fail until it did? Because here's the mystery. How did the smartest bankers in the world, the most powerful financial institutions, the largest economies on earth, all fail at the exact same time? Today we're breaking it down. Not in vague terms, not with confusing jargon, but step by step, the full chain reaction and why it almost happened again. This is the 2008 financial crisis explained, and what you learn today may change how you see the world economy forever. After World War II, the American dream became a real estate dream. Home ownership wasn't just a goal, it was a promise. Banks lent money, families bought homes, everyone won. But by the 1980s something changed. The world of finance evolved or mutated, depending on how you see it. Banks were no longer content making money slowly through traditional loans. They wanted scale, growth, exponential profit. And in 1999, when the Glass-Steagall Act, a law separating investment banks from regular banks, was repealed, the game board changed forever. It was like taking the guardrails off a mountain road. At night, during a storm, now investment banks, commercial banks, hedge funds, everyone could mix, merge, gamble with complex financial products. The financial system turned into a casino where the house didn't always win, because sometimes the house didn't know what game it was playing. And into this world walked something new, something that promised to make everyone rich, something called the start of the domino chain. Subprime mortgages. Let's simplify. Prime loans, safe, predictable borrowers. Subprime loans, higher risk, unstable income, bad credit history. Traditionally, banks avoided subprime loans because they were risky, but now there was a way to turn even bad loans into something profitable. How? With a machine called securitization. Here's the hack. 1. A bank lends money to a homebuyer even if they're risky. 2. Instead of waiting years to get repaid, the bank sells that loan to another institution. 3. That institution bundles thousands of loans into a product called a mortgage-backed security, or MBS. 4. Investors buy the bundles because they're told they're safe. The key word here is told, because the rating agencies, the companies meant to grade risk, stamped these bundles with AAA ratings, meaning the safest investments on earth. Even when 20, 30, 40% of the borrowers couldn't afford their loans. Why? Because rating agencies were paid by the same banks selling the product. Conflict of interest, incentives misaligned, profit over stability. And no one stopped it, because the machine was printing money. For everyone. Banks got fees. Investment firms got returns. Ratings agencies got clients. Real estate prices soared. And regular Americans, they were told, don't worry, housing prices only go up. But in economics, when everyone believes something can't collapse, that's usually the moment it's already collapsing. Because the fuse was lit. Between 2000 and 2006, home prices in the US doubled. Not because homes magically became better, not because demand outgrew supply, but because credit, the ability to borrow money, became unlimited. If you could breathe, you could get a mortgage. Some loans didn't even require proof of income. They were literally called ninja loans. No income, no job asset. Imagine giving a car to someone without checking if they can drive. Now imagine giving them 100 cars, and then betting your retirement on their ability to drive all of them safely. That was the housing market. And while the public saw rising home values as wealth, behind the curtain the financial system was becoming a tower made of Jenga blocks, taller, shakier, and one wrong move away from collapse. Because Wall Street didn't stop at MBS, they went deeper. They invented CDOs, collateralized debt obligations. Think of them as bundles, a Frankenstein of debt. If mortgage-backed securities were gunpowder, CDOs were nuclear weapons, and then they insured the nuclear weapons with something called credit default swaps, or CDS financial insurance in case the loans failed. Except the company selling that insurance, AIG, didn't have the money to cover the losses if things went bad. It was like selling fire insurance to every house in a city, while secretly knowing all the houses are made of gasoline, and still no one stopped it, because the money was too good. The collapse begins. Every bubble pops the same way, when the belief that it will never end ends. In 2006, housing prices stopped rising, then they stalled, then they fell. People who had taken subprime loans suddenly owed more than their homes were worth. Defaults skyrocketed, foreclosures followed, and remember those mortgage-backed securities? Those bundles that investors around the world bought when homeowners stopped paying, those bundles turned to poison. Banks realized their assets were worthless. Investors panicked. Trust evaporated. The first domino fell. New Century Financial, a major subprime lender, filed for bankruptcy. Then Bear Stearns collapsed. Then the unthinkable happened. September 15, 2008, Lehman Brothers, a 158-year-old investment bank, declared bankruptcy. To this day, it remains the largest bankruptcy in U.S. history. People describe that day like watching a skyscraper fall in slow motion. The global financial system froze. Credit markets stopped. Businesses couldn't get loans. Payrolls went unpaid. Stock markets crashed. The United States government faced a decision: let the system burn, or intervene. And so, in a moment that still divides economists today, the government stepped in, not to save homeowners, not to save families, but to save the banks. A $700 billion bailout called TARP, the Troubled Asset Relief Program, was launched, because the belief was if the banks fell, the economy would fall with them, and maybe they were right, or maybe that was the point where capitalism died, and a different system too big to fail, capitalism, took over. Between 2008 and 2010, 8.8 million jobs were lost, nearly 4 million homes were foreclosed, household wealth fell by $19 trillion, and here's the twist most people don't know. No major Wall Street executive went to prison, not one. Instead, banks consolidated and became even bigger. CEOs collected bonuses the next year. Ordinary people paid the price. The system reset. But not everyone recovered. Because a crisis isn't about numbers, it's about people. The family who lost their home after 20 years. The retiree whose pension vanished. The student who entered a job market with no jobs. The worker whose career never recovered. These aren't headlines, they're scars. After the crisis, politicians promised reform, and yes, some regulations were introduced. Dodd-Frank Act tightened oversight. Stress tests were applied to banks. Risky trading practices were limited. But over the next decade, lobbying, deregulation pressures, and market innovation created new loopholes. And by the 2020s, the system was once again built on high-leverage speculative assets, unchecked innovation, fragile confidence. Here's where the story returns to the present, because in 2023, Silicon Valley Bank collapsed. In 2024, global commercial real estate debt reached breaking levels. Household debt worldwide hit a record high. The same pattern appears again. 1. Easy credit. 2. Rising asset prices. 3. Institutional overconfidence. 4. Fragile systems under stress, like a ghost returning to the scene of a crime. The 2008 crisis whispers through every market. Learn from me, or repeat me. Today, U.S. household debt, $17.5 trillion. Global derivative market, $600 plus trillion. Average home price to income ratio, highest in history. 40% of Americans can't handle a $400 emergency. 1% of the world owns 47% of all global wealth. In other words, the symptoms that led to 2008 are not gone, they've just evolved. There's a phrase in finance: stability breeds instability. When systems feel safe, people take bigger risks. When risks grow, the system becomes unstable. It's not a glitch, it's a cycle. The real question is, where are we in the cycle right now? 3 clear takeaways. So, what did 2008 teach us? Takeaway number 1, if a financial product is so complex no one can explain it simply, it's probably a hidden risk. Takeaway number 2, regulation isn't anti-growth. Sometimes it's the only thing preventing a wildfire. Takeaway number 3, when profits are privatized and losses are socialized, the system is not capitalism, it's moral hazard on a global scale. Open question. So here's the question I want to leave you with. If the system didn't fundamentally change, and the incentives didn't fundamentally change, then did the crisis end? Or are we just living in the space between the last disaster and the next one? Because if we want to avoid repeating 2008, the first step is understanding how it happened. If you learned something today, if this breakdown helped you understand the world just a little bit better, please consider liking this video. It helps more people find it. Subscribing for deeper economic breakdowns. Turning on notifications so you don't miss the next chapter, and comment below. Do you think the next crisis has already started? Why or why not? Your perspective matters, and I read every comment. Thank you for watching. Stay curious, stay informed, and I'll see you in the next one.